Hey guys, welcome back to another video. So in this video, I'm going to show you a simple, easy to use strategy that I've been using for so many years. Now, this strategy is actually one of my favorites. I'm going to simplify it here in the most basic terms. Now, you have to understand, in order to do this strategy, you need to have money in your account, in your brokerage account. The minimum would be to have money to buy 100 shares of a stock. It doesn't mean that you're going to buy 100 shares of a stock, but that money is going to be tied up in a contract for you to be willing to buy 100 shares of a stock. Now, yes, you can always get out of this contract, but in this video, just to simplify it, we're going to assume that once you get into that contract, we're going to let the options expire. And then at the end, I'll tell you what you can do if you decide to maybe not go through with the deal, right? So again, this is called a cash secure put. In your brokerage account, you need to have the money up as collateral to buy 100 shares of a stock because that money is going to be tied up, right? So when I do this strategy, I always do it on a stock that I'm willing to hold already, looking to buy, whether it's short term or long term. Even if you are a long term investor, if you use this strategy, what it means, they're pretty much simply paying you money up front as credit, as premium. It instantly goes into your account because you're saying, hey, I'm willing to buy shares of the stock, maybe at a cheaper price, and you're going to get paid for it. So, what is the downside of getting paid to buy shares of a stock that you're willing to buy already anyway? So, that's what I mean, even if you're long term, you're pretty much getting paid to buy your favorite stock. Now, let me give you an example as to what I'm doing. This is actually one of my favorite strategies that I've been doing for so long, along with the covered call. So, again, in my opinion, do it on stocks that you're looking to buy already, willing to hold for a little bit, because the worst thing that can happen, and that's if you look at it that way, right, is that your money's gonna be used to buy 100 shares of a stock. Now, again, I say it depends on how you look at it. If I'm looking to buy the shares already, then what's the big deal, right? I got paid to buy shares that I wanted anyway. But let's take, for example, Boeing, right? The ticker symbol is BA. And don't pay attention to, the price. I'm just giving you this example because I already have a position with that strategy on Boeing. You can use this strategy on any other stock. Depends on what the price of the stock is. Then you're going to need the money to put up as collateral to buy 100 shares of the stock. But the great thing about this is that you can pick the price that you're willing to pay. So today is Saturday. The market is closed, but on Friday, Boeing ended around $184.81. So let's say 185, just to make it simple for this video, right? So the price of the stock, and then when you do this, there's always entries and exits, stuff like that. But I'm going to simplify it for you today. So let's say $185 is the price of Boeing right now, right? It is the price because around Friday, it ended around this price. And you're like, okay, I'm willing to buy 100 shares of Boeing, but 185, should I wait till it goes down in price and buy? Or, you don't know what's going to happen, right? In a cash secure put, you can put the price that you're willing to buy for the shares. Again, to do this, you need the money in your account to be willing to buy 100 shares of a stock. So when I got into this trade, Boeing was trading around $180 or so. And I said, you can see the play right here. Now, Boeing, March 14th, $175 put. So this is pretty much selling a put option, a cash secure put. Now, when Boeing again was trading around 180, I'm like, okay, I don't want to pay 180. How about 175 between now and March 14th? So let's write that down. I picked 175, right? Obviously, it's a lot cheaper than 180 between now and March 14th. There you go. So March 14th is pretty much the expiration date. Now, to do this strategy, if I'm willing to buy 100 shares of Boeing at 175, even though currently it's at 185, right? Because this is what it ended at on Friday. And even though when I did it, it was around $180, that means I'm willing to buy it at a cheaper price. And it's a stock that I was willing to buy already. When I do this, so if I'm willing to buy it at 175, how much do you think I have to put up as collateral? Well, 175 times 100 would be 17,500, right? That's my collateral. That's my investment. That's how much I would need to have in my account in order to do this strategy. Now, it is a lot of money, but again, pay attention to the strategy, not how much money it is, because you can apply this strategy to any other stock that's a lot cheaper. There's a lot of stocks that are like $9, $8, $10. But I do recommend doing this strategy on stocks that you're looking to buy already, that you understand, that you like. Maybe it's long term, short term, right? You have to understand this. Now, I do it on lots of different stocks, but I do understand how they move, the risks, and all that. So far, that's what I'm willing to pay, right? I put up $17,500 as collateral to be willing to buy Boeing at a cheaper price. And this is the good part about it. If I'm willing to buy them already, and I'm willing to buy them at a cheaper price than what it's currently trending, so what's the risk? A lot of people say the risk is that you can get assigned meaning your money can be used to buy them at that price if the price of the stock goes down. And when you do this kind of strategy, and let's assume, right, we get into the strategy and we have until March 14th. On the last day of expiration, let's say March 14th, today is March 14th, Boeing ends up below 175 and we let the option expire. It's the last day. The only thing that would happen, you don't lose your 17,500. You don't lose your investment. All that's going to happen is your $17,500 that's tied up in that contract is going to turn into stock. It's going to turn into shares of that company. It's going to be used to buy 100 shares of the stock. So now your money turns into shares, even though in your account you might be down, right? Now the value of your account might be down, but your money's still there. Now, to do this, right, you had to put up money up as collateral. But here's the good thing, in my opinion, right? We got paid money up front for doing this. Now, we got paid a certain amount of money per share. One contract equals 100 shares. So that's one contract on selling a cashier put, but it's 100 shares that we were willing to buy. So it's 330, right? 300, no, this turns out to be $330 pretty much that we get paid in premium. This is 330 per share. So this is where we get paid money, right? We got paid $330 instantly into our account when we did this trade. So we already know what happens if Boeing ends up going below 175. Now it can go below the same day, the next day, the following day, following week, right? goes up and down. The value of the contract will change. Your account will, value changes. But focus on the last day, right? Just focus on the last day for now. Today is March 14th. Boeing ends up below 175. Yes, you will be down on your account, but your money turns into shares. Now you have 100 shares of Boeing at 175. So first, you got them at a cheaper price, right? You were willing to pay 180 a few weeks ago, but you ended up getting them at a cheaper price. And you're going to keep the $330, right? You made $330 for buying shares of a stock that you were willing to buy already, right? You were already willing to buy them and you bought them at a discount. That's scenario number one. Now, scenario number two, today is March 14th. Boeing ends up above 175. Above, okay? The only thing that's going to happen, the $17,500 that you put up as collateral, it's going back into your account. They're going to release that collateral. And you're still going to keep the $330 that they gave you. Whether the stock goes up, goes down, you end up keeping the $330. Now, this is assuming, of course, that we're letting the options expire. I will do a separate video where you can get out of the contract a lot sooner and still make money, right? Or if you decide to get out, you're like, okay, I changed my mind. Maybe the stock is going way, way too low. Then you can end up maybe losing a little bit more money, but you release the capital, right? Now, again, when you do this kind of strategy, do it on stocks that you're looking to buy already. I'm looking to buy it already. Boeing was around $180, right? And let me just explain this real fast as to, getting out of the contract and all that. So when I did this with Boeing, right, it was around $180. Because the price of the stock went up, now the chances of me getting assigned, it's called assignments, right? When you get assigned to buy 100 shares at 175, because it went up, the chances of me buying 100 shares, being forced to buy the 100 shares is less. The chances are less. So the contract starts to lose value. Now, it lost some value already because when I did this, it was 180 for Boeing. Now it's around 185. So you can see the profit and loss here. It's around $74. All that means is I can get out of the contract. They gave me $330, but I can get out of it for $70 less. So that means I would keep the difference and I would untie the capital. So if the price of the stock starts going up, that means the chances are of me getting assigned to buy them at 175 are slim. And so that is better for me. I can untie this capital for a lot less money and keep the difference. I would make less money, but I would still make money. Now, I do this a lot. If you want to see what happens when you do get assigned, let's say I do get assigned to buy at 175, again, my money turns into shares of the stock, so I don't lose the money. It only becomes an investment in shares. Then I turn around and sell covered calls. That's a different topic for a different video. If you guys like this kind of content, want to learn more, please follow me, share, like. Until then, I'll see you guys on the next video.